thank everybody for logging in and calling into today's webinar. We have a special guest on today that's going to talk to us and talk about investing in multifamily real estate. And we're going to talk a little bit here at the beginning about the IRA side of things, but I think today's webinar is going to be very informative, especially if you're listening live. You're going to have the ability, as we're talking here, to ask questions of either myself or our guest host. You can just type those questions into the chat box on your screen. If you're somebody who's listening to the recorded version, you can jot down either my information or Gino's information and give us a call afterwards after you finish listening to the recording. But again, today we're excited to have a guest talk about multifamily real estate investing. My name is Scott Maurer. I am the Director of Business Development for Advanta IRA. I've been with the company since 2006. During that time, I've handled a lot of different types of real estate investments. We have had many clients invest into multifamily projects, also buy single-family homes that they rehab themselves. There's a lot of different things you can do inside your IRA account when it comes to real estate. In today's class, we're going to focus on, I'm excited to have Gino on, because we really haven't had an expert or someone talk to us specifically about doing multifamily projects. And we'll have him join us in just a few minutes. Just a quick disclaimer that Advanta IRA does not endorse any particular products or really any investment strategy. That's completely up to you to decide in working with your particular investors that you work with, your CPA, or other people who can give you some guidance on what you should or shouldn't be doing inside the IRA. Now, we talk about tax and legal issues from time to time in our seminars, but to get full I guess the disclosures or full decisions made regarding your account from a tax or legal or even investment perspective, please do consult those other individuals. Now, for those of you who are not familiar with Advanta IRA and who we are, we've been around for a while. We only handle self-directed IRAs, or in some cases self-directed 401k accounts, and being that we do not sell any products, we don't sell any particular investments. Our service is to provide record-keeping services for you and what assets you want to invest in. That's really what the nature of being a self-directed IRA is that you're in control choosing the investments, not having an advisor or someone maybe have your money in the stock market being able to choose what you want to invest in. We have over 5,100 clients, almost 5,200 clients, active clients now at Advanta, and actually we have the slide's a little bit old. It says 700 million. We're up close to 900 million and beyond, pushing that billion-dollar mark of assets under management. And our system is set up that any new client who signs up with Advanta is assigned to a specific account manager, one person who will help them with either investments, questions regarding their accounts, really giving a personal touch and really a concierge-type service for any investors. We also believe very strongly in Advanta at providing a lot of education, whether that's our live seminars. We have an office in both Tampa, in the Tampa Bay area, and also in the Atlanta area where we do live seminars. We also do webinars like the one you're listening to now that you can access from your computer or desktop, wherever you are located. We do some networking events, but the genesis and the reason behind having those types of events is we want people to be educated about what it is that they're investing into and getting as much information as possible. Sometimes our events are just one of us here at Advanta talking about self-direction, but as is the case with today's webinar, a lot of times we do like to bring in experts and individuals who can talk very intelligently about other concepts related to self-directed IRAs, but just not something that we can do directly. So we're believe very strongly in education, and we have an on-demand channel on YouTube where you can catch the recording of this webinar once it's posted and any of our past webinars with our other guest speakers as well on that YouTube channel. We also have a blog that we like to update again with some pertinent posts, some good information if you're wondering how the tax law might affect, the tax changes might affect IRAs, or how doing due diligence on particular investments. We like to post some of those guest blog articles as well on our website there. So most of you on this call have probably at least heard of self-directed IRAs. Many of you are probably actually self-directing already on your own and investing in alternative assets. But why haven't more people heard about investing in real estate, investing in multifamily projects, investing in notes and mortgages, the biggest reason is simply because most IRA custodians are banks and brokerage firms who offer their clients only those investments in which they're going to sell. Like if you go to Vanguard, you can buy a number of different mutual funds, but you can't really buy anything outside of that because Vanguard's made the business decision not to hold any other type of alternative asset. Same thing would be with an E-Trade or maybe your local bank holding just a money market account. Each custodian can decide what it is that they want to hold. It's just really that the IRS regulations allow for a broader range of investments, but each custodian can decide ultimately what types of assets that they're willing to hold. So the types of accounts that really can be self-directed are the same types of IRAs that you would have at that bank or that brokerage firm, whether you have a traditional or a Roth IRA account, you have a SEP or a simple because you're self-employed. If you have an individual solo 401k as a self-employed individuals, we can hold those here as well. Also not on this list is any former 401k, 403b, 457 plan. You work for the government, you work for a private employer, you built up that type of plan, you leave that employer, that money can also be moved over and can be self-directed as well. And the process is fairly simple for doing so. It's usually considered either a transfer or a direct rollover depending on really where the account is currently housed. If it's an IRA that you have at a brokerage firm that you want to self-direct, it's considered a trustee-to-trustee transfer. If it's that old 401k, that old 403b, you're doing a direct rollover to Advana. In either case, the transfer or the direct rollover can be done unlimited amount of times. It can be done in partial amounts, which means you don't have to move your entire balance over to a self-directed account. And most importantly, this is a non-taxable movement of money. So taking your $50,000 or $100,000 from your IRA at a bank brokerage firm, moving it to Advana, it's non-taxable. You can make investments. You can move the money back and forth. And you can do that as often as you like. It typically does take probably between 1 and 2 weeks for most transfers and rollovers to come in. Sometimes a little bit shorter, sometimes a little bit longer, just depending on the individual custodian. So we talk about the types of assets, again, that you can hold in a self-directed IRA. A lot of what we invest in is real estate. And a lot of if you've been on these webinars before, you're listening to other recordings that we have, we talk a lot about investing in real estate. And it's because 80% of the assets that we hold at Advana are real estate related. Okay, individuals investing in single-family homes, either for a long-term rental. We've had clients who own property now for 12 or 13 years, just churning that rental income back into their IRA account. Also, people doing shorter-term projects, rehabs, short-term rentals within their IRA account, private notes, mortgages. You can invest in mobile homes, parks. You can all these assets are in that real estate realm. And again, it really depends on your individual preference on what kind of assets that you want to purchase. So we see, again, tax liens, real estate investment trusts. We see a number, one of the things that we've been seeing more and more of lately are people investing into either like a syndication or a private placement where an individual or a company is creating an investment opportunity not for you to own a single-family home or a duplex, but rather investing into their project where they may be redeveloping a large multifamily apartment complex, or they're looking to build from the ground up some new investment opportunity where your IRA isn't really buying one unit and buying an apartment or buying a house, but just buying into that particular investment. That certainly is possible to do as well. And again, the common thread, you can see at the bottom of the slide that all of these assets have is that a brokerage firm doesn't hold these types of assets. They're not going to. It's not in their business model. They don't want to hold them. But again, the IRS is okay with you holding those particular investments. Now, we're going to talk again about multifamily with Gino here in just a moment, but kind of give you an example of what that transaction looks like for someone who's investing in a private placement using their IRA. So we have Jane has money sitting in her Vanguard IRA account. And she meets Randy. He's got an offering. He's going to be purchasing, remodeling, and then hopefully renting out an apartment complex, a big multifamily a deal for him to get invested in. Now, he's provided Jane with the subscription documents, the prospectus, kind of here's what our plans are to buy. Here's what we're looking to buy the complex for. Here's what our plans are to remodel it. Here's what we project our returns to be to all our investors. So it's important that Jane review that and know that she's okay and do her due diligence on Randy and the investment. Once she's satisfied with that she wants to move forward, Jane would open up an account with us at Advanta. We would work with her to transfer that $100,000 from her Vanguard IRA. Again, a trustee-to-trustee transfer. So she completes that packet, completes the forms. We will then open up the account, and she's going to have that $100,000 sitting in her particular IRA account with us. The next step is that Jane's account manager, I mentioned we have account managers for all accounts here at Advanta. That account manager will work with her to make sure the investment documents get completed in the name of her IRA account. And that's the important part for us to demonstrate to the IRS that this investment is not one that Jane is making personally, but rather her IRA as its own entity is purchasing this asset. So all returns are going to be coming back into her IRA on a tax-deferred or tax-free basis. And ultimately, we're going to sign all the subscription documents, wire the funds for the investment once Jane has approved of the documents, and then any future dividends or profits that are basically made on this investment are going to be sent into Jane's IRA account. So the gains, again, are not included in her income because it's income back to her IRA, and she can then exit the investment according to whatever the subscription documents say, or when she does, all the proceeds can come back to the IRA account with no tax consequence to Jane whatsoever. So it's kind of just a quick overview of how a self-directed IRA might invest in a private placement, or in this case, a multifamily investment. But the main part of today's presentation is going to be bringing on Gino Barbaro with Wheelbarrow Profits to really talk to us about a couple different things. I think it's important to note in when Gino talks today that if you're an investor like Jane was in the last example, where you're looking at maybe just being a passive investor and buying a piece of something, there's going to be some good information that Gino's going to talk about to let you know how that would work and what things you should know. But also if you're somebody who's looking at getting into buying multifamily projects and actually being Randy in the last example, looking for other investors, how that process works and what you need to know really about multifamily. And I just want to make sure that everybody knows, again, if you have questions either on anything I covered or anything that Gino talks about here coming up, please make sure that you type your question into the chat box. We'll get to those questions as soon as we can. But at this time, I want to bring in Gino Barbaro, again, Wheelbarrow Profits. He had a class this past November, just about a month or so ago, that we were part of as a speaker in as well. I wasn't the one that attended from Havana. I heard it went very well, a lot of good information. So Gino, how are you doing today?
I'm doing good, Scott. How are you?
Very good. Well, I'm going to turn the controls over to you. And again, if anyone has questions, I'll monitor the questions coming in and make sure that I get those asked. But I'll turn the controls over to you, Gino, and kind of tell us what we need to know about multifamily investing.
Sure. Let me just give you, I guess, a brief 30-second overview of what I've been able to accomplish over the last few years. Bought my first multifamily in February of 2013. It was a 25-unit property. I bought it with my partner, Jake. We've been able to scale in the last 5 years up to about 860 units. It's been a really great ride. We've been able to ride the market. During that process, we created an education company called Jake and Gino, and this is where you see Wheelbarrow Profits. We started a podcast about almost 2 years ago. We've got 110 episodes into it. I just love the whole multifamily education. I'm thrilled that I actually started it because one of my students actually referred me to Scott. I have not syndicated any deals. This is all our own capital. We're refinancing it, repurposing the money. So one of my students was having troubles in his syndication. He ended up reaching out to Scott. He made a great connection with Scott, and that's how I ended up learning about Scott's platform. And the one thing I can say about Advanta, I haven't used them yet, but it seems like it's a great platform. They gave us a landing page. It makes it very easy if you're a person who's trying to raise money for your deals to get money out there. The last thing you need to do is to botch up all of your information and to have your investors really frustrated. The landing page they set up for us, it's a wonderful tool. You get all your documents to Scott. He'll take care of everything. As I said, we're part of the education company. Jake and I like to say this is our motto, make it happen. Because, in life, as you guys know, if you sit around doing nothing, it's going to be really hard to start going on. This is what Jake and I started out with. Basically, I had a restaurant. Jake was a pharmaceutical rep. What I love really about multifamily education, and multifamily real estate specifically, is you can start it part-time. You're able to scale up a business to buy a little property, do it part-time. Jake and I took about a year and a half to be able to get out of his job. That was his ultimate dream, to be able to create enough passive income through multifamily real estate. He retired, quote unquote retired. He's working harder now, but he's doing something he loves, and he's creating, his own, I guess, destiny. About a year and a half after his first deal, I've got 6 children, and I lived in New York, so it took me a little bit longer. It took me about 3 years. Got out of my restaurant in March of 2016, proceeded to move down to Florida here in June of 2017. So it's afforded me a completely different lifestyle. I'm able to be free, able to do what I want, able to be on these webinars. What I'd like to do is I'd like to give you an ebook at the end of the call. If you'd like, reach out to me. My email is gino@jakeandgino.com. Love to get you that information over. As you can see here, regular garden-style apartments. We've been able to accumulate $40 million of real estate in those 5 years. Tuesday we'll be closing on another deal, which is worth $9 million. So we're going to be hitting the $50 million mark at that point. If you watched any of these shows, we've got a really large presence. We've been on the Bigger Pockets podcast. We've had Grant Cardone on our show. We've got one of the top podcasts on iTunes. So, why are you guys here? I mean, you're just like, I guess, us a few years ago. It's all about education, guys. It's all about learning why you want to do something. And, multifamily real estate offers a lot of different aspects that other types of investments don't. And we're going to jump into that in this webinar. And this is basically our 3-legged framework. Jake had the epiphany one day. He's out in the backyard cutting grass, and he sees a wheelbarrow. And he says to himself, wow, there's 3 parts when you're dealing with multifamily real estate. You have to buy the asset correctly, you have to manage the asset correctly, and you have to finance it correctly. Now, if you do the buy right correctly and you do the finance right correctly, you need to manage it. Managing is an ongoing operation. Now, if one of those legs does not work or you've done it inefficiently, what happens to the wheelbarrow? It will topple over. So that's, we came up with that. So we teach all about how you buy right, all about the managing aspect of it and the financing aspect of it. And what we've been able to do is we've been able to create a company, a vertically integrated company where we handle all aspects of the business. We self-manage our assets and we take care of our portfolio ourselves. Now, what I thought was relevant about multifamily real estate is to create wealth, you need these 5 commandments, I like to call them. I read this from somebody in someone's book, and I thought it was so relevant to this conversation. And I want you to take this away, guys, into any venture you're doing. In any successful business that you need, the first thing you need is an actual need. Well, that's awesome with multifamily real estate because, as you're going to see, and if you follow our podcast, we talk a lot about affordable housing. You need about 150,000 units of affordable housing coming online per year. And unfortunately, they're only creating about 50,000 per year. So you can see there's such a huge gap in affordable housing and the space that we play in. And that's really part of the problem with what's going on in the real estate space. You're seeing all these beautiful luxury apartments going up. Well, a lot of those apartments are not servicing the people that need it. So multifamily real estate, that need that you need affordable housing is an awesome way to start creating wealth. The second one is entry. I know a lot of people on the call are going to say, well, you know what, apartments, I can't get into it. They're just so complicated. Anything more, 5 or more, is so hard to get into. Well, when people create a hard barrier to entry, that's where there's a lot of profit going on. Now, in my restaurant business, the problem with a restaurant was more likely I had a pizzeria too. Anybody can open up a business. Now, when that happens, your profit margins tend to slip, and everyone starts jumping in, and everyone starts, quote unquote, pun included, taking a piece of the pie away. Well, with multifamily real estate, there's barriers to entry. People think they need to have capital, they need to have experience, they need to be in the right marketplace. So that barrier to entry really, really works, I guess, in our favor. The next one I think is huge. It's control. We have control of our multifamily real estate with our investments. I'm not giving money and buying stocks and hoping that the board of directors at Apple does a great job. I'm controlling my asset. I'm controlling it. I'm raising rents. I can control the expenses. I can hire my managers, fire my managers. I can refinance my property. I can sell my property. So that control is really huge. And the other thing is you're controlling your forms of revenue. Let me give you an example. A lot of guys out there are using YouTube as a way to monetize their videos. Well, YouTube tomorrow can change their algorithm or change their bylaws, and your revenue is gone. You think you have control on that platform, but you ultimately don't have control. I think with multifamily real estate, you have total control of that asset. The next one is the scalability, which I talked about. A lot of guys on this call, they might be doing single-family homes where you buy one home here, one home there. I got to tell you something. And when we bought our first 25-unit property, it was 25 units in one space. We were able to do it part-time. We were able to actually go. Our next deal was 36 units. So we actually had a portfolio of 60 units within the span of 6 months. We were able to actually hire resident managers. We were actually able to hire maintenance people, and we were able to scale the business and grow it. Very difficult to do that with single-family homes. Next one is time. I think time is really crucial, guys. As I just mentioned, we're able to hire these people to actually help us create a business and not create a job. And this is one of the things that happens when people are in real estate. They tend to get burned out. Now, what's going on? All of a sudden, you become a landlord. You don't become an asset manager, or you're not trying to grow a business. All you're trying to do is focus on these menial tasks. Whereas when you have multifamily real estate, you're able to hire a resident manager or a maintenance guy to take care of those menial tasks. Now, take a look at this screen. I'll leave it up here for a second. If you want to write down these 10 reasons why we like to invest in them. We actually focused on the very first one, Jake and I, when we first started. We had no idea there were so many, benefits. The first one is that high yield. Multifamily real estate does offer nice and attractive cash-on-cash returns. You want to be able to, yield and get cash flow every month. That's the name of the game in this business. A lot of times in single-family homes, when you only have one person paying that rent, what happens when that property goes vacant? Well, you're not getting any yield for that month, or more or less for the year. But when you have 25 units like we bought, you can still have a couple of vacancies. You can still pay the mortgage, and there still will be money left over at the end of the month. Next one is forced appreciation. Great thing about multifamily real estate, it's all about something called the net operating income. If you can force up your net operating income, which is basically either increasing your income or decreasing your expenses, you're forcing the appreciation, which is another thing that we talked about, the control. You're actually controlling the asset. When you're buying a single-family home, you're actually looking down the street and looking at, well, what did that 3-bedroom, 2-bath house sell for? That's basically what you're going to be able to get with yours. It's more of a sales comp approach. In multifamily real estate, it has a lot to do with cap rates, obviously, yes, but it also has to do with the ability to control that income, that operating income, increase it, and you're going to force the appreciation. Now, the third one, equity through leverage. Not many assets that you can, put down 20% on a deal and own 100% of all of the benefits. And, the reason why you can do that, banks know that real estate is, a safer. There's no such thing as no risk, but it's a much safer investment than a lot of other investments out there. So that leverage is amazing. The tax advantages. I want you all guys to all go on afterwards and just Google the term cost segregation. Cost segregation simply is a term that you're actually segregating your assets, and you're actually able to accelerate the depreciation. You're getting these huge tax benefits through multifamily real estate. And as you can see, a lot of high net worth earners are putting money into these assets. And that's why it's great with the self-directed IRA. You're able to get a lot of these funds from these high net worth earners. They're looking for these tax advantages, and multifamily real estate offers them. Hedge against inflation, it's simply, rents go up every year. They go up with inflation. So as inflation goes up 2 to 3%, you're going to see that rents basically tend to mirror inflation. So you're hedging yourself against inflation. The sixth one, we talked about the scalability. Scalability is basically you're able to scale the asset up, able to buy multiple units and create that business. And the same thing with the economies of scale. Much easier to get better pricing with economies of scale. When you have 3 or 4 single-family homes and you're cutting grass, you're going to get one price. But when you have 5 or 6 different properties, you're able to get much better pricing. The ability to improve your local community, I mean, this one was an ancillary benefit and really hit us after our second or third deal. What I like about our space is, we tend to deal with blue-collar workers. We tend to deal with, a tenant base that wants something that's modern. They want affordable, clean, and safe. And we've been able to do that. And what's been really amazing is we take over all of our properties. These people are just looking to be served. And the people are looking for maintenance, and they're looking for customer service. And we've been able to do that. And if you can do that and you can affect your community in a positive way, you're going to be able to make a lot of money in the process. The number 9 is something that really struck me. We had no idea going in this what refi and roll was. Basically, we're talking about forcing the appreciation. You're buying the asset right. At the end of 12, 18, 24 months, when you're able to actually force that appreciation, we like to actually go out, refinance the money, pull the money out tax-free, and we roll that money into a new asset. So in the last 5 years, we've been able to refinance over $7.3 million on all of our deals, just through our efficiencies, just through being able to buy right. So all that money, we've actually been able to repurpose it and continue to grow the platform. That's why we're not syndicating. We haven't syndicated any deals yet. And I guess the last one is the wealth creation. As you can see what happens, you're getting the tax benefits. Your tenants are paying off your mortgage. You're cash flowing every month. You're able to refinance this money tax-free, and you're able to continue to buy assets. That really, really creates a huge form of wealth creation.
Yeah, Gino, if I can just jump in real quick, I just want to make sure everybody can, if you have any questions, get them asked in to the chat box on your screen. But kind of going back to that list of 10 things that, what is something where you think someone who's just getting into multifamily, what you think is going to be the most important thing on here that they really need to understand in getting into multifamily to be successful?
Great question. I think the first thing that anybody needs to understand is you need to buy on actual numbers, and you really need to buy a property that cash flows. Be safe. Don't buy a property on where it's going to happen in the future. I see that mistake so many times. Oh, well, they're going to be putting a shopping center 2 years down the road, or, oh, we're going to be able to build another 10 units. No, you need to buy the asset at what the actual value is, and you have to be able to buy it with the positive cash flow. Because, they have a term for an asset or a property that is actually negatively cash flowing. It's called an alligator. And an alligator, what it does it do to you? It eats you alive. And, how do I know, Scott? Because I've had some of those before. I've had them in my prior past when I was investing up in New York. You always say to yourself, you know what? It's the greater fool theory. Let me buy this property because I know it's going to appreciate in value. But you don't do that when you're buying in multifamily. You need to buy, and you need to be making money from day one. Does that make sense?
No, that makes tremendous sense. That's a great point. So go ahead, continue on again. If anyone has questions, get them asked in the chat box. We'll make sure to get Gino to answer them.
And Stephanie, I like the comments you made. I did a podcast with a gentleman yesterday. Company is called Impact Housing, a really great crowdfunding platform where they're actually talking about impacting housing at the affordable level, where they're actually adding on amenities and stuff. So there are so many ways to actually affect and create value. That's what we're ultimately trying to do in multifamily. What you're trying to do with these properties is you're trying to create a community within a community. You're trying to serve these tenants, and your long-term strategy is to try to create that community, whether it's adding a soccer field to Hispanic tenants, whether it's offering English lessons, whether it's creating a fitness center where you can have yoga, classes there. You're trying to create that community because you want these tenants to stay there long term. So I would look up that company called Impact Housing. I think you'll like it. Now this was our first case study. Just go through it really quick with you. As you can see, it was 25 units. It was really well neglected. 1-bedroom cottages, fourplexes all over the place. We loved it. This is the one that was rehabbed. As you can see now, it's got a nice little metal roof on there. This is what tenants are looking for in the affordable space. This little 1-bedroom cottage, most people will look at it, but when you're on a fixed income and you're able to pay $600 a month, you have your own little tiny little house like that. Great value add there. Let's go over this case study that we had. What we did was, on this property, it was a $600,000 acquisition. We put 10% down. Now, we used something called seller financing. The sellers were very motivated to sell this property. And as you can see in the previous slide, not the nicest looking property, especially when we took it over. So they were motivated, to say the least. We were able to negotiate 10% seller financing where they held a note, and they also did some repairs for us. So this was our first deal. We didn't have any team members. We didn't know what we were doing, but we knew that we needed some work done, and they actually ended up doing some work for us. So the numbers looked like it was a $600,000 purchase. We were able to put $60,000 down of our own money, plus another $23,000 in closing costs. So we came out of pocket with $83,000, and the sellers held a $60,000 note. So we were able to control a $600,000 asset with only $80,000 out of our pocket. Now let's just talk about what was going on with this property. As you can see, this is what was going on with it. You can see there was tons of interior and exterior deferred maintenance. A lot of little small issues that anybody can take care of. Paint, mailboxes look terrible. One of the big things with this property was they were mom and pop. We call them owners. They didn't have any kind of systems in place. They were renting to weekly renters, which in the short term creates a lot more revenue for you, but in the long term it creates a ton of problems. These tenants are in for 3 weeks, they leave, they destroy the property. You have to go back and fix up the units. So it was a struggle for us in the beginning. We moved away from that model very quickly because we wanted to start having better tenants. So we started screening tenants. We started actually implementing our systems. So these are some of the solutions. Basically, we took care of the deferred maintenance, put in new mailboxes, start fixing the roofs, start painting, start taking care of the landscaping. You have to look at it as a place where, I don't know if you'd like to live there, but when you want people to drive by, they're going to get that first or second impression. If they get a bad impression in the first 5 seconds, you've lost them. So you really need to start taking care of the outside of the property and then start serving the tenants. We started doing background checks, and we started evicting all undesirable tenants. Really important thing to start doing. You can't start renting to people by your gut. You need to start running this as a business and start doing these tenant background checks. We started implementing the professional management. We actually had a maintenance person on staff. We were able to hire somebody part-time. What happens was, we also created a website, started looking professional. People actually starting to Google us and starting to find out where we were, had nice pictures on there. We were putting videos on our website to show people what the apartments look like. And all of a sudden, we started attracting that new tenant base. So this is the value plays that we had. On this property, and a lot of mom and pop properties you're going to see, they have storage units, or they have garages that are filled with a ton of crap. It's amazing. They'll even use apartments sometimes as storage units. What we ended up doing is we ended up cleaning these storage units out, and we ended up renting them out for $50 a month, an extra $150 a month, and actually providing the service to the tenants. Another thing that was mind-boggling to me was their operating expenses were really, really excessive. They kept paying garbage fees. They kept paying phone bills. They never went out and shopped these bills. You have to shop these operators and these contract providers every single year. They're paying cable to the tenants, $7,000 a year in cable. We actually ended up taking off the cable. If the tenants want cable, you pay your own cable, right? And we implemented something called utility buyback system. It's basically called a ratio utility billing system, where the landlord was paying for all the tenants' utilities, water, sewer, and electric. We actually ended up implementing that system. If you'd like more information on that, it's a really huge value play. There's a company called NWP. Go online, Google them, and they have terrific information on how you can implement your own ratio utility billing system.
Hey, Gino, if I can, again, jump in
Yep.
with a quick question on that deal.
Sure.
I mean, you're talking about what you're doing. What obviously you had some great solutions and some great things you did to increase your cash flow to add value to the property. Maybe what was a mistake you might have made, though? You said it's one of your first deals. Like, what was you make sure they don't do?
We got enough time in this call? I don't know if we got enough time on the call, but I'll hit you up with a couple. The first thing we did was we didn't do enough due diligence when we bought the property. So 6 months after we bought the property, our septic fields went. $9,000 later, which I thought was a great price, but still, it hurt our cash flow for a few months. We should have done a better job with our due diligence. We should have been more diligent, for lack of a better word, to actually comb through the property. Now, I mean, in fairness, it was wintertime, very difficult to test them. But what we could have said was, hey, let's leave a few $1,000s in escrow. Let's make sure these things work. When we come back in the springtime, we'll give you your money back. We didn't do that. I think another thing that we made a mistake on was we went in there and we didn't have proper rent rolls. We actually ended up having to go to knock on every door because that's just the paper trail that they had there. They just didn't have any kind of paper trail. So we just had to go knock on every single door, verify people, and take them at their word. I'm trying to think of this. There were so many mistakes we made. I think holding on to the weekly renters was another big mistake. We didn't implement it quick enough because it's unfortunate, but people, when they pay by the week, they'd rather pay $200 a week or pay $600 per month. They can't budget their money. So to a landlord, $800 per month as opposed to $600 is very attractive. But at the end of the day, you're going to be turning over those apartments, and there's going to be so much more to fix up, and your expenses are going to be much higher.
And I think you referenced too. I mean, maybe the type of tenant you get on a week-to-week basis probably a little bit different than somebody who's paying at least monthly. Much
different. And I think one of the other things, just trying to think if there's anything like that really stuck out, because it was a tough property. I mean, I wish we had raised a little bit more money in the beginning to take care of the repairs a lot quicker. That was another mistake. Maybe we should have loaned a little bit more, borrowed a little bit more money from the bank. We actually ended up doing a lot of these repairs through our, cash flow monthly, and then when we refinanced the property. But it was our first property, so we weren't full gung-ho, and it wasn't one of those things where we thought, hey, we're going to do this forever. We just took a stab at it and said, hey, is this going to work? And that's why. We didn't really think of it as the end game. What are we trying to accomplish with this property?
Okay, yeah, we had a quick question pop up. I think you're going to get into this right now, too, but somebody said, Daniel asked, did you purchase your apartment building all cash? I think you said no. It was 10% cash down and 10% seller finance.
Yes. Yep. Normally on these multifamily deals, all cash is I wouldn't say it's rare. In certain markets, it might be very, very competitive, so you'd want to come in with an all-cash offer. But, I mean, when you're trying to buy a $2 or $3 million deal, a lot of people don't have that cash, so it's mostly bank financing. Now, you can use a community bank where they might be a little more lenient. We've put down 15% on a lot of our deals at community. If you're going to use agency financing, whether it's a Fannie deal or a Freddie, they normally want 20 to 25% down. But, I mean, Scott, we did a deal a year and a half ago. It was $11 million deal. It was 281 units. We put no money down. It was a 20% owner finance deal, seller financing, 80% bank. So, I mean, there's so many different ways to structure these deals, but to go as far as I guess the rule of thumb, look between 15 to 20%. And it's very difficult. We got very fortunate in our first deal to do seller financing. We were just fortunate enough that we learned about it. We were fortunate enough that our broker was privy to it. He was smart to it, and he actually recommended it to us. And I was like, that's a great idea. So that's how we were fortunate to fall into it.
Okay, and the second part of his question, I think you're getting into this too. What strategy would you suggest if it is a finance transaction, how to refinance to pull the money out for a future deal? I think that's exactly what you're about to hit on, so I'll let you get back into it.
Yeah, sure. Well, what we ended up doing with this deal, I mean, let me just go through this slide, and I'll show you the refi and roll slide. Our portfolio, a year after we bought that property, was 197 units, and then 3 years later, we hit 674 units. So this is the refi and roll slide. This is the courtyard cottage that I had referenced, the 25 units. We cashed out $183,000 on that property. 18 months after we purchased it, with the market accelerating and cap rates dropping, and also with all of our fixes, we were able to refinance out $183,000. We only put down 83, remember? We were able to pull out 183. How did we do that? Well, basically, first thing was the revenue on the property was generating between $10,000 and $11,000 a month when we took over. We increased that revenue to, I think, between $14,000 and $15,000 a month. That's the first thing. Second thing was, remember those expenses? Those expenses were really, really high, between the turnover costs, between evicting the tenants, between all those expenses that they're paying. We dramatically cut them. So as you can see, you're increasing income and you're decreasing expenses at the same time. That's going to obviously raise your income and your net operating income dramatically, and that's what banks look for. So on this deal, we're able to pull out $183,000, and this is the rest of our portfolio. This was the first phase of our refinance and refi and repo, we like to call. The first phase was we pulled out $4 million, refinanced tax-free to us. Completed this last one, 156 units. These two, we've just done them on the next one, but this last $500,000 one we did about 12 months ago. Now, on this next slide, which I don't have, we've accomplished the Hammond one. We were able to pull out $600,000. This Park Place Apartments here, we're able to pull out an additional $2.2 million in this deal. And it really is all about the income. When we took over Park Place Apartments back in February of 2014, they were generating only $52,000 per month on 136 units. Well, this month, we're in excess of $100,000 in revenue. So as you can see, you're looking for these value adds where you can increase these rents, and if you can do that, you're going to be able to really increase the value on these properties. So, I mean, a lot of you on here, I'm sure you have a lot of, myths and all your objections to why I came to multifamily. I want you to really take a look at this slide and see if any of these really resonate with you, because a lot of them resonate with a lot of our students, and they actually resonate with me when I first started out. The first one is not enough money for multifamily. I mean, I hear that all the time, and unfortunately, guys, it's really not the money that you have to really focus on right now. You really have to focus on your education, and you really have to focus on actually finding these deals, creating broker networks, finding the market. It's great that I'm on a self-directed IRA podcast right now, because that's where you're going to find the money. You're going to find the money from potential investors. So don't focus on the money. Focus on the opportunity, because if you find that deal, I will guarantee you there are tons of people out there that want to place the capital. And also the second strategy we used was the owner financing. Owner financing was another way that we used to alleviate our ability to come up with that capital. And the third one is partnerships. I mean, I love partnerships. I was blessed to be able to find Jake, be able to partner with him. I've been able to partner with him and another partner on all of our units. So that partnership was really powerful for us. And as you can see, that money starts small, and you start refinancing these deals, and there's your money for your next deal. Too much time to invest, I sort of dispelled that also. You can get into this part-time because, as I said, I've got 6 children. I've got a large family, huge commitment of time. If anyone's ever run a restaurant or worked in a restaurant, I was working 55, 60 hours a week. Great place to start multifamily as part-time. Too competitive. It might be too competitive, but what isn't competitive? I think single-family homes are so much more competitive because there are so many more people in that space. And as you can see, the margins on flipping a house are $10,000 to $20,000, and that'll tell you how competitive the market is. People have that barrier to entry. I can't get into multifamily. To me, in the space where we play between 50 and 100 units, there's less competition. Next one, financing is too difficult. To me, I totally disagree with this. When you look for a multifamily deal, a lot of financing is incumbent or really focuses on the asset itself. If you're buying a property that qualifies for it, you're going to find a ton of different financing strategies out there, whether it's a community bank, whether it's agency debt, whether it's private money. There's so many different ways to finance your deal. Next one, won't find a market. This one is tough for a lot of people. Some people in their backyard, like me in New York, I couldn't invest in my backyard. So what I ended up doing was I ended up going to Rochester, New York, which is about 8 hours out of my backyard. Found a couple of deals there. I started learning how to invest outside my backyard. Ended up going down to Tennessee, where my partner Jake lived, and ended up investing in that market. Next one, will not find a management company. This is difficult for a lot of guys, basically. Because it's either they want to self-manage, and that's why I always tell people on your first or second deal, great idea to find a management company, correct? But I'd like to self-manage my properties in the very beginning to get that experience so that when you actually go on and start hiring a management company, you know what systems they need, you know what they have to do to be a successful management company. Can't find a deal. Well, I mean, in our platform, we have so many investors out there sourcing deals. Right now, it's a difficult part of the market, but we closed a 64-unit deal 2 weeks ago, and we're closing 100 units in a week from now. So going out there, finding those deals, it's challenging for people, but I think in all aspects of the market right now, whether it's single family or it's commercial, it's a little bit more challenging right now. I have a question there from Vandy. Mortgages are only short-term with balloons, a drawback versus houses, correct? It is. Most commercial financing on community banks, they'll give you something called a 5-year term, balloon 5 or 7. We have our community financing where we'll do 10-year terms on them. So you'll have financing locked up for 10 years. Residential, you have 30-year amortizations, 30-year terms. The financing on commercial is shorter with the balloons. But you know what? That would never stop me in a second because, like I said, on our courtyard deal, we had a 5-year balloon on that property. After a year and a half, we refinanced it out. We pushed that term out to 10 years. So that's something that should not stop you.
Hey, and Gino, one of the other questions popped up too. Someone
Sure.
you were just mentioning about maybe finding the deal. Someone said, how do you find these units? Do and maybe I know you said now you have a network of people who can help.
Oh, sure. Yes.
How did you find that first deal though? Was it the same kind of community of people you were talking to, or did you go use an agent? Maybe how does someone find the deal?
Well, the first thing with multifamily real estate, and I think real estate in general, you really have to, it's really all about networking. You can go online and Google and Facebook, but you really need to get in front of brokers. You really need to pick a market. Let's say you're dealing in Knoxville, Tennessee, where we are. You need to go on LoopNet. You need to find out who the brokers are in that market, and you need to start making contact with them. Take them out to lunch. Ask them questions. Find out what's going on in the market. You need to get in front of them. You need to go on your local area real estate associations, whether it's a REIA meeting. Go there and start meeting people who are in the space. And, once you become known, Jake and I are known as the mom and pop kings. All the brokers know exactly the kind of deal we're looking for. They will shop it out, and they will send us the deal. Now, on that first deal we found, believe it or not, a lot of our deals, we find them on LoopNet. These mom-and-pop owners, they had this deal on for over 2 years, and it just sat there stagnant. We took a shot at it, and a broker, a friend of ours, actually brought it to us. He knew what we were looking for. So, the most important thing with multifamily is really getting out there, networking, and creating those broker relationships, and letting the brokers know what you want. Set up an acquisition criteria sheet. What am I looking for? What type of return are you looking for? What asset size are you looking for? Where are you looking in the market? What you're willing to do, what value adds you're looking to create with the property. All those things you need to convey to a broker so he knows what to look for. Your broker is going to be qualifying you. You have to sell yourself to the broker as well as the broker trying to sell himself. Does that make sense?
Yeah, definitely think so. That's similar, I think, for people getting into real estate investing in general. I think too many people sit back and just are not sure how to find the deal, how to start. But like you said, get out there and meet people and network, and you'll learn the ropes.
I think it's like that in any business. I mean, for you to grow the platform on Advanta, you've got this wonderful platform here. One of my students actually does webinars. He'll go on, he'll create webinars, he'll create content to try to draw traffic to himself. But what he's ultimately trying to do is he's really trying to get to those brokers and talking to them and seeing what they have out there. And, my recommendation is if you're a first-time investor, try to choose 1 or 2 markets. Try not to go scattered where you're trying to do 5 or 6 different markets, because when your focus is on that many markets, it's very difficult to try to create a relationship with brokers. You're trying to build a team out. Try to keep it, compact. 1, at the most, 2 different markets. So over here, our breakthrough, what happened with us, we discovered our niche. I think everyone has to have a niche in their business. We love mom and pop apartments. We came up with the name because that just seems like that's who we kept buying from, right? The second thing we came up with is that framework that I mentioned: buy right, manage right, finance right. Now, I want to talk to you guys about what a mom and pop owner is and what you guys should be looking for in real estate. Now, I'm going to keep this slide up here for you because I think this is the key to anything to deal with real estate in general, whether you're buying a single-family home, whether you're buying an office complex. You need to have some type of motivated seller to be able to get a deal. And that's what I think the key characteristic of a mom and pop owner is. And I'll go through the few that we've encountered in all of our purchases, because in every single one of our purchases, we've had some type of motivated seller. The first one that we bought, the courtyard cottage that we show you, basically, hey, listen, they were burned out. They were ready to retire, believe it or not, and they had health issues. So they had a triple whammy going on. So they just wanted to get out. Our second deal was an out-of-town owner. We know he was out of California. We know he wanted to sell. Our third deal, there was partner acrimony. There was a doctor who was a partner with a management company. He thought he was getting the short end of the stick. He might have had a little credibility and a little veracity in that, but he just wanted to get out. That created that type of motivation. A lot of these here, guys, code violations. Properties have problems on them. The owners can't fix them, don't want to fix them, or don't have the money. That's a definite motivated seller there. So take a look at all these and always focus on these types of sellers. Now, in our buy right, like this is what we've been trying to focus on now. We look at properties hopefully with an 8% cap rate. Some markets, that's laughable. You're not going to get anywhere close to that. But in our Knoxville market, it's been fluctuating between 7 and 8 caps right now. That second number is that 10% cash-on-cash return. We want a property that generates at least 10% cash-on-cash return. And the third one is basically something called the debt coverage ratio. Very simple. A debt coverage ratio is anything where you're paying any income that is over your expenses. So basically, a 1.4 debt coverage ratio would mean that you're generating 40% more income than what the mortgage payment on the property is. The higher that number, 1.5, 1.6, the safer the property is. If you're at a 1.0 debt coverage ratio, you are in big, big trouble, because 1.0, basically, you're paying enough, you're earning enough money in that property to actually pay the debt, and that's it. You have nothing left over. I see Michael asking, what is the cap rate? Basically, a cap rate is a rate of return on the property that doesn't take into consideration any debt. It's just a simple nominal rate of return on a property. In this environment, the higher the cap rate, it's an inverse relationship with the price. The higher your cap rate is, the lower the price is. As cap rates have been going down in this environment, the prices have been escalating because you're getting a rate of return less on your money. You have to understand what cap rates are in every single market, because real estate is market specific. What's going on in Buffalo, New York, which is a very linear market, they say it doesn't appreciate, there's no bubble, there's no burst. That cap rate or that rate of return in that market is going to be significantly different than what's going on in Los Angeles, California. Los Angeles, California is a market that's hot, it's been really appreciating, so cap rates are dropping. So you really need to know what the cap rates are. And you know what? Just Google cap rate and you'll find out what the equation is to calculate cap rates. Now, the manage right portion of it, basically, we like to teach, this is our 3-step framework. When you get into a property, you have a lot of these units that might be down. The first thing you need to take care of is you need to fill up those vacant units at market. That's the very first thing. Second thing, we mentioned, if these units do not have rubs on them, and a lot of these mom and pops don't build back, we take care of the rubs. And the third thing is we go in and we start raising rents on any units that are not at market rate. Very simple, guys. Just go on apartments.com. We use a website called rentometer.com. Also, to check what the markets are, what market rents are in your market. You need to know exactly what rents are, because if you're trying to charge $650 for a 2-bedroom, but your market is $620, guess what? Tenants have a unique ability to know exactly what they should be paying, so your apartment is going to stay vacant. So you need to know what the rents are in that market. So use apartments.com, use rentometer.com, and start pushing those rents. And, when I say start pushing those rents, you're not going to go into a property and all of a sudden start raising rents. You're going to need to start adding value to that property, whether it's, we talked about the landscaping outside, whether it's the customer service, whether it's taking care of the interior of the units. All these things need to be happening while you're raising those rents. And the finance portion, we spoke about it with community financing or agency financing. I want to show you this slide. This one was really, hit me hard a few months ago. I want everyone to think, what does that mean to you? Basically, it only takes one. I mean, this is really, I guess, specific to everybody. For me, it only took one deal for me to become financially free, that 136 unit. It only took one partnership for me to become super successful. So, just think about it. It only takes one what? Really specific. I got very fortunate, as I said, with Jake. It only takes one idea. It only takes one connection. It only takes one thought, very specific to you. And, the real relevance to this picture is on the bottom left over there, Jake actually rented that apartment back in 2011 in Knoxville, 2-bedroom apartment. And now, this 6 months ago, we're looking at buying this apartment complex. Unfortunately, it was just priced really way too high. But in 6 years, it's amazing where his life has shifted because of multifamily. I guess some house rules here. I mean, we do have education, not a get-rich-quick plan. Multifamily real estate, you have to understand, just like anything else in life, there's a lot of work to go into this because there's a lot of stuff you need to learn. If anyone says, I guess our results are untypical, but let me tell you, if a guy who had a pizzeria and a guy who was a pharmaceutical rep can do it, I guess anybody can do it, right? We do have multifamily coaching. We do offer educational platform. We have a great private Facebook group. As Scott said, we had a nice, I would say, an amazing event. I'm glad he spoke. And it's pretty ironic because they were one of the last speakers of the event, and they had more Q&A through the self-directed IRA because I think people didn't understand the way to use a self-directed IRA. A lot of people were there thinking about using their own money to invest. But I think the other aspect of it is, hey, if I'm a real estate investor, this is a fantastic way for me to get money to actually, to actually start my own business. So, any questions?
Yeah, but Gino, that was great. I think I would just remind everybody too. You offered at the beginning, I think, an ebook. People email you. It was Gino@jakeandgino.com. I did put that in the notes there to the chat box for everyone to see. But anyone who's listening to the recording, email Gino@jakeandgino.com to get that and hopefully get some more information. As you said, Gino, what do you think is the biggest thing you'd want? I mean, we are addressing two different kind of people today. One person who's more of a passive investor who wants just a piece of it, and then you have somebody who is maybe looking at getting into this space on their own and kind of doing what you do. What do you think is the first step that for both of those two individuals to take to kind of get into multifamily?
Oh, that's a really great question. I mean, I'm a life coach. I became certified 3 years ago. So for me, when I became super successful and I become super successful at anything, I think you all have to stop and think about what your mission and what your purpose is. If your mission and purpose is only to make money or only become rich, I think it's going to fall short. My mission and my purpose to do this and to become a full-time investor was to really have my lifestyle dictate my business. For me, my business was dictating my lifestyle. I was stuck at a location. I couldn't go anywhere. So when I really thought about multifamily real estate, that's what drew me. I could actually do this anywhere I wanted to, and I could actually have the lifestyle that I wanted. So I want everybody out there, really just step back and think what your mission and what your purpose is in life. Do you want to become a passive investor where you give your money off to somebody and have somebody do all the work for you? That's a great strategy. You can live your life. You can continue to do your 9-to-5 job. You can continue to have your career, whether you're an attorney, whether you're a stay-at-home mom, whatever you're doing. That's a fantastic way to do it using the self-directed IRA. Or do you actually want to become an investor full-time like Jake and I did? We just love the idea of actually starting to scale a business, to grow a business, and ultimately we've morphed that into Jake and Gino. So I guess Stephanie's asking me, how much time does it take to be on the ground to establish a new investment? Well, on the 25-unit property, actually, let me backtrack that. It took Jake and I 18 months, believe it or not, to find that first deal. And unfortunately, what Jake did was he moved down there. We're super gung-ho. We're going at it. I had a little bit of experience. I knew what we were looking for. He goes out and buys a house. And, the wife supersedes Gino, so I couldn't really yell at him. So that I guess set us back a little bit, but I still had that mission and purpose, like I mentioned to you guys. You really need to know what your exit strategy is, why you're doing this, and what you want to get out of it. Because if you can figure out your why, you're going to ultimately end up figuring out how to do it. And that's what I ended up doing. I ended up partnering with Jake. That was my how. I know why I wanted to do it. So I just kept on top of him. It took us 18 months to buy that first deal, to get that first deal. And then after we bought it, it took us an additional 12 months to actually reposition the property, to fix the property up. Now, on the deals we buy, they're much larger. They're, anywhere from, 50 units to 200 units. It'll take you a little bit longer to establish and to reposition it. But, a 25-unit, 30-unit property in your first deal, it should take you about 12 months to fix that property up.
And were you cash flowing that property pretty quickly right off the bat? I think you mentioned that was very important, but was that something where did you have a month or two of negative cash flow, or were you positive the whole time?
Believe it or not, we've been positive ever since on that property because we bought it right. We paid really well, and even with the owner financing and that debt on there, we were still able to. Now, those months we used to pay for the septic, we just took it out of the cash flow. We didn't take any owner draws. But that's one of the things that we liked with the partnership. We didn't have any investors in the beginning, and that's why we like to start small. We wanted to actually start the business, see if the model worked, and then once that model worked, hey, let's take on another partner and let's continue to go.
Right. I mean, great information, Gino. I really appreciate you coming on. We're right here towards the end of the time. If anyone has a last-minute question, jump it in or type it in real quick. But some really good information. I think, again, I want to appreciate you coming on because we've never had anyone really talk about this type of investing and this kind of different space that so many people associate real estate investing. A lot of people, they associate that with what they see on TV, which is the fix and flip Chip and Joanna Gaines or the Flip This House,
Yes.
whatnot. And there's so many more things that are out there that you can do. As you
Yep.
said, even better cap rates, better yields, etc. Just putting a little bit more work in. And I'm glad we're able to illustrate that and bring that to everybody's attention.
So, Scott, what I'll do is also anyone on the webinar, if they want to, just email me, and I'll also give them a copy of our book for free. We wrote a Wheelbarrow Profits best-selling book. It's on Amazon, about 175 pages. It outlines everything we've talked about in the book. It goes into depth more, but I think it's a really good place for you to start if you get interested in multifamily real estate. We've gotten a lot of reviews. Actually, Grant Cardone, if you got anybody knows on there, he actually mentioned that that's the only real estate book he's ever read. So I take that as an actual huge compliment because the guy owns over 4,000 units. So if anybody's interested in getting the book, just let me know and I'll email you a copy for free.
Yeah, again, that was Gino at jakeandgino.com. I would encourage people to download your podcast, get on those as well, because I was appreciative to be a guest on there to talk to people about self-directed IRAs, and I know you have a lot of other professionals that really help people give them the full picture of multifamily investing and all those different components to really start to build that out.
Definitely.
All right. Well, again, at this time, we'll conclude the webinar. Again, if you're listening to the recorded version, you can reach out to me at Advance IRA. Again, my name is Scott Maurer, number 727-581-9853. If you want to reach out to Gino to get a copy of those books or maybe to find out more about his Wheelbarrow Profits podcast and what he and Jake are doing, email him at gino@jakeandgino.com. Gino, again, thank you very much. Excellent content, great webinar.
Scott, thanks a lot. I'm glad I met you. And like I said, I had a great time at the live event with you guys. You have a great service. It's all about customer service. And listen, if you need a place to go for your self-directed IRA, you're talking to the right guy.
All right. Thanks, Gino. You have a good one.
Thanks. You too.